Guys, I'm updating my portfolio today. These are the 18 stocks that I currently own, and I'm looking to buy much more of these companies. Okay, let's get into them. Stock number one, PayPal. Now, PayPal has had a fall from grace, reaching an all-time high of $310 a share on July 26. Now, I personally did the Peter Lynch approach. I used PayPal all the time whenever I wanted to do some sort of transaction where I was secure. And Venmo, I love it. Owned by PayPal. That's what attracted me to PayPal. But unfortunately, the first time I was attracted to PayPal was on $250 a share as it was climbing. So I sat there and said, you know what? It's a company that I love, but I'm not going to buy it because it doesn't make sense to me. Now, obviously, since then, it's had the fall from grace, hitting as low as $50 per share back in October. Now, let's go check out the 8 pillars. It's an 8-pillar stock, but remember, doesn't mean that you just buy. The pillars are here to tell a story. And the story tells me that, okay, decent return on invested capital, buying back shares, hopefully at the right price, free cash flow growth, net income growth, and all these things are working together. Good 5-year price to free cash flow, lower than the 5-year PE. Awesome stuff happening here. Let's see what analysts are saying about this company. Now, the funny thing about all this is, the most common thing I hear about PayPal is, the company is dying. What people are really saying is the stock price is lower, because wherever the stock price goes, that's where the news goes. If the stock was up to $700 a share, people would be saying, this is the best company ever. These are the earnings per share, according to analysts, going from $4.29 to $8.15. Now, guys, analysts are just like you and I. They have their bias. So I don't know if this is true or not, but the whole point is these guys are going to sit here and make these assumptions after looking at the stock price falling. So I like the fact that on a falling stock price, they still have an optimistic future. And for this dying company, look at that revenue growth. 8%, 8%, 7.5, 7.5, 10. Guys, it's not growing like gangbusters. And PayPal is in a very competitive field. But Venmo, PayPal, a couple downsides of PayPal, the number of active users has declined, but the big upside is the amount of transactions and the price per transaction is way up. So I'm still optimistic on PayPal. Let's go check out where I have it on my stock analyzer tool the last time I did it. Let's look at my assumptions. 10-year analysis, I did 4, 7, and 10% revenue growth. This is just wide range. Profit margin, I did 12.5, 15.5, 18.5. Free cash flow, as you can see, guys, is always higher over the last 10 years, 5 years, 1 year. So I did 16, 20, and 24. Now, I did go a little more conservative on the multiples of PE and price of free cash flow because it's in a competitive field. So I did 13 on the low side, 19 on the high side, 16 in the middle. And if you're new to our channel, you're going to see me putting in a 9% desired return. The market's going to do 9 or 10%. This is kind of my way of saying this is intrinsic value. But remember, you need to put margin of safety. Because if your goal is just to make 9 or 10%, save yourself a lot of trouble. Buy a long-term, low-cost ETF and just ride it out for a long time. So if you want to buy individual stocks, I truly believe you need a higher desired return. That gives you that margin of safety. Hit the Analyze button. And I got a low price of 55 to 70, high price of 160 to 200. Middle price of 95 to 122. So I feel very comfortable on this position, and I'm going to be adding more as it falls. And I'm also going to be using cash secured puts to buy more shares. Stock number 2, Ulta Beauty. The thing I like about this company is whenever I talk to women about Ulta, I hear rave reviews. You go in an Ulta, nice and clean, very easy to deal with. They have same store sales growth, which is really hard in the retail world. They're expanding intelligently. So first off, return on invested capital, 23% over 5 years, 29%. Guys, this is high quality businesses get these kind of returns on invested capital. Microsoft, I think, might be a little bit above this. That's how high quality of a business this is. For a retail location, $18.5 billion market cap, $21.5 billion enterprise value. That's only $3 billion in net debt against $900 million in free cash flow. And for retail, that's pretty low. So I love that a lot. Let's go check out the 8 pillars here. Buying back shares, hopefully at better prices. Now you might look at it and go, Paul, it's selling for 20 times free cash flow and 15 times earnings. It's not exactly a screaming deal, but with this high return on invested capital, and as it gets cheaper, they can buy back more shares at a cheaper price. That's what I like about it. Let's see what analyst estimates are expecting. $26 a share in earnings now, 43 in the next 5 years. apart from 1 year, basically double-digit growth. And even on revenue, guys, look at this revenue growth. I'm surprised by this. 5, 6, 6, 7, 6. I haven't even mentioned the 11% this year. So pretty solid revenue growth for a retail location. And I like the fact that they don't pay a dividend, which is awesome. They're going to focus on buying back cheap shares, which is my goal. The stock's currently at $383. Let's check it out on our stock analyzer tool to see what my assumptions were in the past. I did 3, 5, and 7% revenue growth. I did 9.5, 10 and a quarter, 11 for both profit margin and free cash flow margin. I did 15, 18, and 21. It's retail, so you should probably get lower, but it's got a really high return on invested capital. So I gave it a premium. And again, our 9% return. Guys, 340 on the low side, 660 on the high side, 475 in the middle. Based on today's price and my middle assumptions occurring, that's a 12% return. I like that, and I'm hoping it goes even further south on every single stock I buy. Guys, I want to repeat something here. I have bought stocks where I've made money on it and realized I was wrong and sold. I have lost money on stocks in a short run, and I keep buying more. That's the key to proper investing. The proper investor is the kind of person who can find a thesis as the price goes down, buy more of it, and still make sure that thesis is still the same. We're all going to change our thesis at some point. The biggest example is Carnival Cruise Line for me. I made an assumption after COVID on debt and number of shares, and they went way higher on both. That's why I sold, but I made money. So did that make me right? In my opinion, it did not make me right. It just made me lucky because I don't know where stocks are going to go any given moment. But for Ulta Beauty, I'm hoping for every single stock I own, I'm hoping the stock goes lower so I can buy more shares. Stock number 3, the very, very controversial Alibaba. This stock also has had a fall from grace, as you can see right here from this chart. All-time high of $319 per share back on October 27th, 2020. That's almost 4 years and a fall from grace. Now, this is all, in my opinion, driven by geopolitics. You look at Alibaba, you see a growing business. You actually see a business that sells more in terms of gross merchandise value than even Amazon does. The stock is currently selling for 9 times free cash flow because the earnings have been very skewed. Let's look at the pillars here. A low return on invested capital, which I think is skewed by recent results, and a decrease in net income, which was write-offs that they had here. Because look at their free cash flow, up over the last 5 years by $2 billion. Let's go check out that free cash flow. Annual level, last year, $21 billion. 23 the year before, 12.5, 26. Guys, this is a company generating over $20 billion in free cash flow with $196 billion market cap. And enterprise value of $207 billion. So minus 196 is $11 billion. They generate $21 billion. So 21 divided by 11, they can pay off their debt in under 1.5 years. That's incredible. In less than half a year, imagine if you could take all the cash in your account and pay off every debt you have in less than 6 months of the cash flow you generate. That's what's going on here with Alibaba, and that's why I'm just waiting for the mood to shift on Alibaba. Remember, for a while there was ADRs. Oh, you don't actually own the company. Well, that's the way it's always been for China stocks. News follows the stock price. Because on the way up, it was a darling. On the way down, it's how stupid to be to believe in communist China. Okay, I just believe China will be better economically 10 years, 20 years from now than today. And I think Alibaba will receive those tailwinds. And when I see 9 times free cash flow, that's very exciting to me. So let's skip right to the stock analyzer tool and check out the last time I did Alibaba. I did a very conservative 3, 6, and 9% revenue growth. I did 15, 19, and 23 on profit margin, 17, 22, and 27 on free cash flow. PE, 16, 18, 20. And I can understand, I do think for the desired return of 9, I think you should have a really high desired return if you're worried about China. First off, if you're even worried about China, you should not even invest in this. And remember, guys, I want to recap. Just because I own these stocks or anybody on the internet owns any stock, you should not buy it. Even if Warren Buffett owns a stock, you should not clone him directly. You should look at him for ideas, but then do your own research. I am here to teach a process, but I've also learned that people want to hear what stocks does Paul own and why. Those are the best students, the people who want to understand why I own a company. Recently, I had a friend, and maybe he was watching this video, and he wrote me a message and said, one of the stocks that I'm going to mention today, he said, Paul, I bought it, and it doubled. Thanks for that. And I wrote back, it has nothing to do with me because it could have gone down. I don't know what's going to happen in the short run. He only owned it for a few months. What I'm trying to teach here is, are you going to buy companies for 5 or 10 years? So we hit the analyze button on Alibaba. I got a low price of 125 to 140, high price of 350 to 400, middle price of 215 to 250. Now, you see this potential return of 28%. Guys, this is high. To me, this is the margin of safety. I'm going to repeat this. If I had 30 companies with these same financial attributes, I would absolutely be in heaven. I would be wrong on a few of them, and I could be wrong on Alibaba, but I'm going to be really, really right on a few of them, and most of them are going to do somewhere in the middle. That would still generate me 15 to 20% returns. That's what investing is. It's about making calculated bets. Now, as you know, Peter Lynch has said 1,000 times, everyone has the brain power to buy stocks. Who has the stomach? I truly believe in keeping investment ideas simple and understanding them, and based on 3 ideas of, is the company going to be around for the long haul? Are they going to make more revenue and profit in that time period? And can I pay a reasonable price for that company that takes into consideration the risks involved to give me an adequate return on my money? That is what's important to me. And I hope you learn from that. It could work perfectly for you, but you're going to have your own way of investing. Just like the thousands of people in our community, they don't all agree with me. There are people who like Bitcoin in there. There are people who think that Tesla at 170 is a screaming deal. We don't agree on everything, but that's what's great about investing. It's about sharing these ideas because there are a lot of great investors out there and they have very different portfolios and they beat the market with different portfolios. I'm just trying to teach that process, but the hardest part of it all is the emotional part. Being able to see a stock fall from grace like Alibaba did, buying it at 150 like I started buying it at, and I got lucky with a little rebound, lost the shares to covered call, and then did a tax loss harvest that made my base a lot lower. Pure luck. But that's what investing is allowing yourself to put yourself in that position of being lucky. The hard part is I'm down on my Alibaba investment right now. Okay. I'm okay with that. Not many people are. So if you want to get better at handling the emotional side and using these tools to make you a better investor, click the link in the description below, join the community. We have a great 7-day trial for you to try out. So make sure you go do that because it is a wonderful experience and it'll change the way in which you handle your money emotionally and how you evaluate companies. Stock number 4, Southwest Airlines. Yesterday, Elliott Management just announced a $2 billion position for about 11% of Southwest. They say that they think the stock will go to 49 in the next 12 months if Southwest listens to them. I think they had some valid points, one of which was their computers are antiquated. That's what caused the problems last year that they're still paying for today. But the interesting thing to me for Southwest is my thesis is based on this. Profit margin last year, 1.5%, 5-year, 0.6%. But let's go check out their financials. You look at their income statement. Here, 11% profit margin, 11%, 15%, 10%. Actually, this one's higher, sorry. This is 12%. Guys, this is not a 1% margin business. And yes, they will get to the point where their margins go back up. And that's my thesis on Southwest. It is selling for 10% more than it did at the COVID, pretty close to the COVID lows. I first bought Southwest at $25 a share. It went straight up from there, lost them at $48 from covered calls, got lucky, and started buying back again in the mid to low 30s. That's what I love. I'm dollar cost averaging. Even though I started buying in the mid 30s, I'm actually up on my position. And again, that doesn't make me right. I have to repeat that over and over. But that's the joy. That's the beauty of dollar cost averaging. When a stock falls lower and you keep buying because your thesis is the same, that's the beauty of it. Let's see what analysts are saying about Southwest. Over triple EPS in the next 4 or 5 years. Over triple. I think they're being a little conservative. Revenue growth, they're already at record revenue, growing 7, 6, 5, 8, 4.5% a year. Pretty good growth. So this is the last time I did Southwest. I did 2, 4, and 6% revenue growth. I did profit margin of 8, 10, and 13. So guys, I still think I'm being conservative here. But remember, I don't need the old Southwest at these prices in my opinion. I did 16, 19, and 22 for PE and price of free cash flow. And again, my 9%, no margin of safety return. But guys, we need margin of safety because valuation is an imprecise art. We have no idea what the future holds. And we're humans. We make mistakes. Hit the analyze button. Boom. A low price of 53, high price of 140, middle price of 85. Same kind of return potential as Alibaba. That's my opinion, but the airline industry is a very difficult industry. It's not for the faint of heart. It's a very difficult industry. Stock number 5, Disney Corp. I think it has very similar issues to Southwest in the fact that their profit margin is absurdly low. 1 year, 1.9%, 5-year average, 2.4 with a gross margin of 35, even though I want you to see this income statement. Look at this revenue. 89 billion the last 1 year. Last full year was 89, 83, 67, 65, 69, 59. Guys, record revenue by a lot. They got to figure out a way to get more profitable. I think that'll happen over time. This is not a 2% margin business. They're going to figure out a way to make more money. That's my thesis on Disney. And again, a little bit of fall from grace. It actually hit an all-time high after COVID of $202 per share. Recent low of $78, and now it's at 103. So let's see what analysts are saying. EPS, 478 to 767. Okay, not something to write home about, not something awful. I'm actually surprised by this. I would have thought it'd been much higher considering their current profit margin. And revenue growth, look at that. 3, 5, 4, 4, 6. All right, nothing to write home about. Again, it's Disney. But I do think it's difficult to replace Disney. They have a great war chest of content that they can use to sell to people and monetize. So let's pull up the stock analyzer on Disney. I did 3, 5, and 7% revenue growth for the next 10 years, 9, 12, and 15% profit margin and free cash flow. PE, 18, 21, and 24. Same with the price of free cash flow and 9% return. Guys, I want to focus you on one thing. Free cash flow last year, 9.4%. Last 10 years, 8.2. Last 10 years, earnings 9% after falling in the last 5 years. That's why I think I'm being conservative here. Hit the analyze button, and this includes dividends. I have a low price of 75, high price of 205, middle price of 130. At the current price, gives us about a 12% return, and I have my watch list at $100 per share. Stock number 6, Target. Target is one that I was buying sub 135 all the way down to 103. Then it skyrocketed as high as 180 back in April. Wow. And look at the volatility here, guys. In October, it was 100. April, it was 180. In 6 months, it went up 80%. I think I bought my last purchase at 103, 105, something like that. So I'm up on Target, even from my original purchase. But again, I want the stock to fall. I absolutely want it to fall. 5-year profit margin, 4.5, 3.9. Their big issue, theft. They're closing locations because of theft. I think that's a temporary issue. The woke thing, I think that's a temporary issue. These are not things that keep me up at night. One of the best things to do is buy companies where stock has fallen because of a temporary issue. I think these two issues are temporary. They're paying a dividend, 3%, which eats up about a little under half of their free cash flow. But I like the fact that their free cash flow last year was higher than their income. And they have a good return on invested capital. 15% over the last 5 years, 12.5% last year. Good stuff here. Let's check out those 8 pillars and see what these look like. Okay, so free cash flow is down over the last 5 years and a little bit more debt, but it's retail. Their leases are included in that. It doesn't worry me at all. So I look at this as a 7 green check company. Okay, fine. Let's see what analyst estimates are saying for EPS growth. 840, which gives it a 12 PE as of today, to $13 in the next 5 years, 4 years, whatever it is. Revenue growth, I'm willing to bet it's 2 or 3%. Yeah, it's basically down this year flat, then 4, 4, 3.5, 3.5. Yeah, this is going to be a company that grows with the economy. So let's go check out our stock analyzer on Target. Pulling it up. I did 2.5, 3.5, and 4.5% revenue growth. Profit margin, 3 3/4, 425, 475. Same thing for free cash flow. PE, 15, 18, 21. This is a higher end mass store like Walmart. I put a 9% return in here. Hit the analyze button. I have a low price of 130, high price of 230, middle price of 173. At the current price of 146, yielding about 11.35% if my middle assumptions occur, including the dividends. So I have my watch list at 135. I'm probably going to sell more puts on that in order to get the stock at lower prices to be paid to do that. Stock number 7, Sprouts Farmers Market. I first saw the store on my dad's 70th birthday trip to Phoenix, Arizona. I'm not a hippie, but I love this company because hippies love to spend money. Look at this profit margin, 4.25% last year, 4% over the last 5-year average. Here's why that's good. Go check out Kroger and those other grocery stores. They're at 1 to 2%. This company makes a lot more money, gross margin of 37%. They have a great new CEO who's really focused on smarter growth. They have about 408 stores growing to 1,250. So there's a great growth path, and same-store sales continue to grow, and they're focusing on high-income areas. This is a company I love. I started buying it around 35, in the low 30s. It was like 32 to 35, and it skyrocketed and pissed me off, up to $75 per share. 100% fact, it made me upset. Now, the analyst estimates on Sprouts is not very good. 315, 336, 369, 376, 347. Not a lot of analysts, but okay, I don't know. I don't necessarily agree with them because the big thing I love about them too is Sprouts keeps selling more and more of their own brand, which has a much higher gross margin than the other brands they sell. And every single year, that makes up more and more percentage of their revenue. I think last year it was around 20 or 22% of their revenue was from their own brand that has about a 50 or 60% gross margin as opposed to the 38 they have. That's a big key there. Now, let's go to Stock Analyzer. Let's pull up Sprouts the last time I did it. Boom. Now, guys, before I hit the Analyze button, right after Sprouts, I'm going to give the rest of the stocks I own, the other 11, and I want you to comment below on those 11, which ones you want me to see make a video on. So make sure you wait till after our Stock Analyzer on Sprouts, I'm going to do right now, to see that full list. So I did 6, 8, and 10% revenue growth, including with growing stores and same-store sales. Profit margin, 3, 8, 4, 4, 2. Same thing with free cash flow. 18, 19, and 20 on the PE. I'm surprised I did such a tight window here, but 9% return. Hit the Analyze button. I have a low price of 55, high price of 90, middle price of 71. So I just got to wait for it to fall much further. Here are the stocks I own. Nike, BTI, Brookfield Asset Management, Intel, 3M, American Express, Paycom, Generac, T-Row, Starbucks, and HPQ. So guys, do me a favor. Give me the stocks that you want to see in our next video to recap the other 11 stocks that I own. If you want to see the process and how I purchase my stocks, please watch this next video.